Welcome to the Retirement Made Easy podcast, a show created to be your go-to source for straightforward retirement advice. Best of all, it is presented in a language that you can understand. Here's your host, certified financial planner, Greg Gonzalez.
Hey, welcome to another episode of the Retirement Made Easy podcast. I'm Greg Gonzalez. Thanks for joining me today. This year in 2026, we are hitting record numbers of downloads. We've been doing the podcast almost 6 years now, and we have more listeners now than we have ever had. Much, much more. So we'll keep doing these episodes. Please keep submitting your questions. retirestrongfa.com. We're going to end today's episode with a bunch of listener questions, some really, really good ones. So we will save the best for last. But we're going to start off today's episode talking about volatility in the market, the ups and downs. And of course, there's the conflict in Iran right now, the war going on as I record this episode, which starting off in 2026 has really shaken up the market. The price of oil has gone up a lot. Most people's 401k balances and retirement savings have gone down as a result of this drop in the market. Inflation has ticked up in the United States, mostly due to the rise in energy prices. But I want to share some perspective around these dips in the market and how that's going to impact you in retirement. Because I can assure you, this will not be the last conflict. This won't be the last dip in the market. So I want to really spend some time on volatility and managing our behavior. I think it's even good for the seasoned investors out there, the long-term investors out there to hear once again. It's refreshing. Because I don't care who you are, nobody likes seeing their 401k balance go down. Nobody does. So I hope to share some good insights on the volatility we've been experiencing and will continue to experience. And we'll talk about, hey, the market will always move in cycles, but then there's also going to be these geopolitical conflicts and issues that arise that will shake the market up at times. So we'll talk about all that in the first segment of the show. How do you handle these periods of contraction and expansion? And as I mentioned, we're going to try to hit as many listener questions as we possibly can. If you're a new listener to the podcast, we welcome you. This podcast, we do not take sponsors. There's no ads. A lot of different companies reach out, but the answer is we're not interested. And as a listener, I think you can appreciate that. You're not going to be bombarded with a big commercial or advertisements that take away from retirement planning, good information, and a language that you can understand. So we're going to keep it that way. And if you're a new listener out there, I invite you to check out our website, retirestrongfa.com. There's a link in the show notes. We have a resource tab where you can download all of our free resources like our retirement secret sauce. We have our 2026 tax planning guides on there. Our Social Security planning guide is on there. Our women's guide to retirement is on there. And then later this year, I'm going to release our retirement playbook. I will make an announcement as soon as that is released and ready to go. And then a special thanks to all the fine listeners that have reached out to us at Retire Strong Financial Advisors. I know many of you were interviewing different advisors to see who's going to be the best fit to help you build a comprehensive retirement strategy. And we are honored that you reached out. And for those of you that are still interested and maybe are considering hiring a financial planner to help you with your retirement planning, there's a forum on our website, retirestrongfa.com. You can reach out that way, and we'll set up a phone meeting to get a conversation started to see if we're going to be a good fit for you and what you're looking for. And I'm personally on many of these welcome calls, and I've just been blown away by how nice and great the people are that we get to meet that may not be local. Most of them are not local to our St. Louis area. We're in St. Louis, Missouri, but it's really been a delight to get to talk to a lot of you listeners out there from across the country. So thank you. All right, let's kick off this episode. Let's start talking about volatility or setbacks in the market, as some people like to say. And as promised, we will wrap up today's episode with as many listener questions as we possibly can. Let's get to it. So this year, in 2026, as I record this podcast, the market is actually down for the year. Now, what is causing this? It's mostly due to the conflict with Iran. Last year in 2025, we ran into the tariffs and what that did to the market temporarily. The market pulled back when there was announcements of the tariffs. And with the tariffs last year in 2025, the market pulled back quite dramatically in a very, very short period of time, but it also rebounded fairly quickly as well. Now, I get to hear all kinds of stories because people like to tell their stories, or they like to share what someone maybe at work that they work with is doing with their 401k, and how when the market went down temporarily 20%, that they got scared and cashed everything out. And now they're sitting in a money market fund where they feel their money is safe. And they sold out of their mutual funds within their 401k at a terrible time. And they realized that loss or that undervalue in the market when they sold because they got scared and they panicked. Now, I've said it before, and I'll say it again. Your best financial decisions are never made in haste. And I will bet the farm on that statement. And what I mean by that is when you're in a moment of panic, when you're in a moment of stress or pain, it's not a good time to make financial decisions. It's kind of like going grocery shopping on an empty stomach. I don't know if you've ever done that, but I have. It's a bad idea. By the time I get home, I got all these groceries and all these things, and I'm going, gosh, why did I buy that? Why did I spend money on that? Why did I make that decision? Well, it seemed like a good idea at the time, but looking back, then I have to live with the regret. And a lot of things I'm not even going to end up eating. But we're talking about your financial future here and making long-term impactful decisions due to maybe a temporary setback in the market, or maybe an announcement of a war, or something that causes the market to collapse all of a sudden. And then we panic and can really make the situation even worse. Now, with that said, if you watch the news, I see the headlines. The market does not go up and down. The market plunges and soars. And if you were getting on an elevator and there was not a button that said up, but the up arrow actually said soar, and then the downward button said plunge, I don't know about you, but I'm not getting on that elevator. So it's really our behavior and how we choose to react to certain situations, whether it's a temporary decline in the market. And notice I said the word temporary, but also one thing I want to point out is as certified financial planners, we're taught to position people's portfolios based on different criteria. And one of the most important factors is what we call risk tolerance, or your appetite for risk. And when the market is soaring, when it's doing very, very well, you can tolerate a lot of risk because it seems to go up and up and up and up. And making money, well, gosh, that feels great. But then when it goes the other direction, what we find is that people were taking more risk than their risk tolerance, than their stomach could handle. And we call that potential upside versus potential downside. And I remember a very famous financial planner that used to say, on the way to reaching your goals, your investments will go up and down in value. And he used to say that so confidently, but what he didn't really specify or go the extra mile to explain was that you can dial the risk that you're taking with your investments, with your portfolio. You can dial that up and down. And generally speaking, again, I'm generalizing here, but the older we get, the more people want to dial back their risk. And it's kind of like this. It's kind of like when I was in my 20s, I could stay up till midnight. I could stay up till 1 or 2 o'clock in the morning. No big deal. I'm in bed. If I make it to 9 o'clock now, I'm middle-aged. If I make it till 9 o'clock, that's a big deal. And typically it's going to be something on TV, maybe a big game, maybe a World Series or something that I'm watching that's going to keep me up that late. It's the same thing with driving too. You can control how much risk you want to take by how fast you drive. And now that I'm at a different season of life, I'm okay kind of driving slower. In my 20s, yeah, I was going the speed limit and then some. Nowadays, I'm generally not in a hurry anywhere I'm going. So just like you can control how fast you drive, you also can have a say in the amount of risk and possible return you have with your retirement savings. And as a retirement planner, my entire career, I've heard people say things like, "Hey, I'm getting close to the doorstep of retirement. I'm just at a point in my life where if I look at my 401k and I have the potential of a 20% growth or 20% return in my 401k this year versus the potential of a 20% loss or setback in my 401k, it's just not worth it to me to take that kind of risk, knowing that a potential 20% setback might cause me to need to work another year longer or change my retirement plan and maybe even adjusting how much I can spend in retirement." And I'll give you an example of this. One more example. In the last 6 months, Bitcoin is down 43%. And that's as I record this podcast today. Obviously, Bitcoin, the price of Bitcoin could rebound in a very short period of time, or it could fall farther. And I bring up just the price of Bitcoin as an example, not that I'm suggesting it be a wise investment for you or anybody else, but just looking at, okay, Bitcoin as an investment, in the last 6 months, it has fallen more than 43%. You get to determine, is Bitcoin something that you want to have? Bitcoin seems to have quite a bit of risk. And is that something that you want to own in your retirement accounts? Something that carries that much risk. And then a follow-up question to that is, maybe you just have a small amount of that, of a risky investment position. And this is what professionals will do. They will look at your different retirement savings accounts and say, which accounts do we want to invest differently than others? Where do we want to position specific accounts to carry more or less risk? Sometimes we like to think of accounts as different buckets of money. And maybe one bucket you position and it carries a higher risk for possible higher return. And you're not going to utilize that bucket of money for income in the next couple years. Maybe you're not planning on touching that bucket of money for at least 5 to 10 years in retirement. And that's one of the greatest pieces of advice that I can give you, is to stop looking at your retirement savings as one big number and investing all of those dollars the exact same. I think you can do better than that and start to break out. Okay, let's say I have a brokerage account over here. I might have Roth money over here that's growing tax-free. Maybe I have a pre-tax 401k or pre-tax IRA over here. And maybe these different buckets of money are working and invested differently. And hopefully you have an emergency fund, a rainy day fund, what one of our clients like to say, a God only knows fund. And that money is protected. It's safe. It is liquid and available and can handle any expenses that might pop up. That's not an account that you want to invest in Bitcoin or scratch off tickets or something like that. Now, at our firm, Retire Strong, we use the Retire Strong bucket strategy. And what that does is it separates your different money into buckets, different accounts into different buckets, and gives them jobs or responsibilities. So having an emergency fund bucket is absolutely crucial. The job of the emergency fund bucket is not to provide income in retirement. That's the job of the income bucket. And then we talk about the growth bucket. So obviously we are separating the different accounts that you might have and investing them differently. Depending on the job or the responsibility of that bucket, that will dictate not only the amount of risk that the investments within the bucket are taking, but it also helps us to align our expectations of each bucket. For example, is the bucket producing the income that we had anticipated or expected from it? Yes, it is. Okay, then mission accomplished. And then maybe looking at your long-term growth bucket, which might have the highest amount of risk that you're taking. Well, that might be the smallest bucket, dollar-wise. It might be the bucket that not only you're taking the most risk with, but you expect the most growth from. And maybe you're not expecting to take withdrawals from that bucket for the first X amount of years of retirement. And so, okay, I'm not as concerned with the fluctuations of that bucket because I consider that my long-term money, my long-term fund. And so the fact that it's down temporarily, I'm okay with that. I'm much more concerned about the bulk of my retirement savings, which are in my first few buckets. So that's how the pros do it. They like to think of, instead of one big number, I have X amount of dollars saved for retirement. They like to say, okay, no, I've got X amount of dollars in Roth. I got X amount of dollars in a brokerage account. Maybe I've got a 401k or a pre-tax IRA over here. Maybe you have other accounts like annuities or other things like that, money market, CDs. These are different accounts, they're taxed differently, and they carry different levels of risk. And if you're working with a financial planner, you can partner with a financial planner and decide the appropriate levels of risk for each bucket or each type of account. And that's one thing financial planners can do, is they can look at how you're invested in your 401k or maybe IRAs or Roth IRAs or brokerage accounts, whatever they are. And we have software that measures your risk that you're taking from 0 to 100, 0 being most conservative, 100 being most aggressive. And I cannot tell you how many times we've run somebody's investments, their portfolio, in our software, and it's come back with a risk score that was either much higher, meaning much riskier than they expected, meaning they didn't think they were taking as much risk as they potentially were. It's kind of like when you get pulled over and the cop says, "Do you know how fast you were going?" And on the flip side, sometimes somebody will say, "Hey, my 401k doesn't seem to be doing anything," or "This other retirement investment account doesn't seem to be growing at all. Can you find out why?" And of course we can. We run it through the risk score, figure out, okay, how much risk they were taking, look at the investments to figure out why somebody's account is just not giving them the growth that they're expecting. Now, one thing I wanted to mention on this segment is if you look back in history of just the market, the stock market in general, every few years, there's going to be a significant setback. It might be a recession. It might be a war. Who knows? It's impossible to predict what the next setback will be. It could be tariffs. It could be a government debt crisis. We're about $39 trillion in debt right now. And what's really, really interesting is, of all U.S. retirement savings in this country, at the end of 2025, according to the Investment Company Institute, we had $49.1 trillion saved in all, 401ks and IRAs, all retirement savings accounts as a whole. $49 trillion is what Americans have saved for retirement versus, we're $39 trillion in debt, and that number is growing. So of that $49 trillion that Americans have saved for retirement, obviously you and I have a very small sliver of that, but we're trying to make the best possible decisions that we can with those dollars to make sure that they last as long as we do. But nobody has a crystal ball. But we know historically, if you live a 30-year retirement, and I'll say this again, it's been a while since I've mentioned this, the average age to retire in the United States is 62 years old. Has been for a long, long time. It's the most popular age to claim Social Security benefits. That does not mean it's the appropriate time for you to claim your Social Security benefit necessarily. It could be, but statistically, it's the most popular age to claim one's benefit at 62. It's also, again, it's the average age of the American retiree is age 62. And if you were bored enough to look at the mortality tables and looked at a hypothetical 62-year-old non-smoking couple in this country, in the United States, average couple, and you said, what is their joint life expectancy? Meaning the age in which the surviving spouse would be predicted to pass away, it's age 92. And so that means you're really planning for a 30-year retirement. Now, that's the average. There are people out there that will surpass age 92. They might live to 102, but we're talking about the average here. So if we're thinking about, okay, the average 30-year retirement, how many recessions or market downturns will you live through during that approximately three decade retirement? It's going to be many. And that's why, in my opinion, how you react in controlling your behavior during those downturns and the changes you make to your retirement savings and your investments during those crucial periods of time, those downturns, is much, much greater than what you actually invest your money in to start out in retirement. Because if you don't keep the investments, what does it matter what you start retirement with? And the last point I want to make is the amount of confidence you have with how you're invested is going to determine whether you stick with the plan. And if you have very, very little confidence in your investments within your different retirement accounts, the first storm that comes in, the first market downturn, you're going to abandon those and you're going to head for safety. And I see this all the time. This last market downturn, you started to hear ads, and a lot of these marketers are actually geniuses at sales, because the ads for gold, for IRAs that invest in gold. Oh, you can buy an IRA today and invest in gold. Whenever the market gets shaky, they are trying to sell on greed and fear. You hear these ads, oh, the price of gold is at all-time highs, and wouldn't you rather have gold in your IRA? That's your retirement savings. And the market's down, the market plunges 2,000 points. And they seem to run these ads very strategically whenever the market starts to tank. They are trying to hit people's emotions, hit them at a time where they're emotional, they're not making logical decisions, and they say, gosh, I'd rather have my money invested in gold at this point because this advertisement is telling me that gold is more secure than having my money in the stock market. And the gold advertisers know this, they know it works, and they know their timing is crucial. Because some people make buying decisions based on fear and greed and not on long-term perspective. So I hope this conversation has been helpful. You're going to go through many, many more of these. We're not done. It will continue. There'll be dips and dives, and it's how you manage those dips and dives and manage your reaction and your behavior towards them that's really going to count and really dictate the success that you have long-term. Again, at Retire Strong, we use the Retire Strong bucket strategy because it makes sense, and not all your money should be invested the same, in our opinion. All right, let's skip to some listener questions. Got some good ones lined up this week. First question's a good one. It says, Greg, really enjoy the podcast. My question is about the widow benefit. I am a widow at 59. Is it true that I can collect my widow benefit at age 60 and then switch over to my own benefit later on? Thank you. Okay, that's a really, really good question. What we're talking about here is this Social Security widow benefit, or survivor benefit is what it's called. And I want to answer the question that's asked, not the question that's not asked here. So yes, that is true. You can collect your widow benefit at age 60. And that's the earliest age that you can collect your survivor benefit or widow benefit unless you are disabled. And then hypothetically, you could switch over to your own benefit later on, and that would be maximized at age 70. Now, without knowing the numbers here, the details, I can't say whether this is going to be the best piece of advice for this person without really running the numbers and knowing about their situation. But I want to answer the question that they ask. Yes, that is possible. If you claim it right away at 60, your survivor benefit, you've still got the earnings limit to be aware of, right? Collecting your benefit before full retirement age, there is an earnings limit that may reduce how much you receive as far as a Social Security benefit. So keep that in mind. And also, just because you can start it at 60, the longer you can delay that survivor benefit, for example, if you just waited 1 year, it would be bigger. That survivor benefit would be bigger every month that you do delay it. And a fun fact that I looked up, what is the average age of a widow in the United States? A widow or widower? And it's actually age 59. So that was kind of surprising to me. I thought it would be a little bit older. That's according to the US Census Bureau data. Question number 2. This is a good one, boy. Somebody writes in saying that they are approaching 70 years old. They have owned this long-term care policy for quite a while, and it's a traditional long-term care policy. They got a letter in the mail saying the premium is going up 30% next year, and they want to know what we would recommend. Should they keep the policy or surrender the policy? So this is a good one. So with traditional long-term care policies, just so people know, is that there's no cash surrender value. There's no death benefit with them. You simply pay your premium, and whether that's an annual premium, a semi-annual, quarterly, monthly, however it is, and then should you go on claim, is what they say, then you would, after the elimination period, which, could be 90 days is elimination periods, meaning the benefit would kick in after 90 days. That's fairly common. That's kind of like the deductible for the insurance company. And after that elimination period, you would start getting benefits out of your long-term care policy. So this person, they're nearing 70 years old. They've owned this policy for quite a while. All of those premiums up until this point, those are sunk costs. So the way to think of that is like if you were a member of a club and all the dues that you had paid into that club for all those years allowed you to participate with the club and go on maybe trips, maybe be a part of special events that the club would host. But that was your annual dues to be a part of the club. It's the same thing with this policy. Those past dues or those past premiums, those are sunk costs. So you've got to kind of think, okay, is this policy still in my best interest to keep? Forgetting about all that money that you've paid into it. Those are sunk costs. Those premiums that you have paid into this policy were to help should you need the care up until this point. But you have not qualified. You've not needed the long-term care up until this point, but you were covered for that period of time. It's kind of like homeowners insurance. If I pay into homeowners insurance, pay my premium for all these years, and my house doesn't burn down, there's not a storm, nothing happens to my roof, that's a sunk cost, right? The money's gone. I don't get a portion of that premium back. And a lot of times what'll happen is with these long-term care policies, they'll send a letter. They do have the ability with traditional long-term care, if there's not a life insurance component to it, they have the ability to raise the premiums on you. But you can also contact them and say, hey, cut us some slack here. What if we keep the premium the same? Are you willing to decrease the benefit, the amount that if we were to go on claim, instead of X amount of dollars a month or X amount of dollars a day, could you reduce that? Let's say it was $100 a day that the long-term care policy would pay for. Instead of that, let's say, hey, they'll do $85 a day and keep our annual premium that we're paying into this policy the same. But just know that they have the ability to do this again in the future. If the insurance company comes back and says, okay, your annual premium's due next year, they can raise it again. Now, of course, we hope they don't, but they have that ability, that they have the ball in their court to do so and make those changes. Now, the other thing that I want people to understand about these policies is you want to check if you own one of these long-term care policies or nursing home insurance policies, you need to understand when it comes time to go on claim and you fill out the paperwork to do so, you want to understand if your policy is a reimbursement policy or if it is an indemnity policy. Now, what's the difference between the two? If you go on claim, and let's say you go to an assisted living place where you need the care, they would actually you would pay for all your expenses, and then the invoices get sent to the insurance company that holds your long-term care, that provides your long-term care policy, and then they reimburse you. So you're not just getting a check every month of $100 a day or whatever it happens to be. You actually have to pay those expenses out of pocket, or have the assisted living or the nursing care provider send the invoice to the insurance company, and then they will reimburse you for those expenses. That's the reimbursement policy. It's kind of a pain in the neck for the adult children or the caring spouse, because you've got to kind of submit those invoices and expenses and then expect to be reimbursed from the insurance company that provides the policy. So I remember back in the day where we had a fax machine. I was 21 or 22 years old helping a client with one of these old policies they had, actually faxing in the invoices of the expenses to the insurance company in hopes that they could be reimbursed for those long-term care expenses. Now, the other type of policy is what's called an indemnity policy. And those, in my opinion, are much, much more convenient. They're easier. Once you go on claim, the insurance company just pays you out that money for whatever the monthly benefit is. So let's say you go on claim, they approve it. After your elimination period is over, let's say it's 90 days is elimination period, and you're on the hook for the first 90 days of expenses. After that 90 days, the elimination period, then the policy actually starts paying. And with the indemnity type policy, you actually get that monthly amount. You don't have to submit invoices and receipts like you do with a reimbursement policy. So just wanted to mention there are two types of policies. And if you have one of these, you want to make sure you understand what you actually own. But getting back to this person's original question, I would really want to run the numbers to see, okay, what's going to make sense here? I would contact the insurance company that offers the long-term care insurance and say, hey, what can we do here? If we wanted to keep the annual premium the same, can we decrease the daily or monthly benefit? Should we go on claim? Is that even an option? Because this is just my opinion, but I think it's really, really rotten for these insurance companies. Once people get closer to going on claims statistically, that they start raising the premiums and pricing people out. And many of these people that bought these policies, maybe 10, 20 years ago, maybe 30 years ago, they can't afford to pay the premiums anymore because the premiums have gone up so much over time. I don't think that's right. And while we're on the topic of long-term care insurance, this comes up with a lot of our clients. They want to know, okay, what are the options here if we were looking at these different policies? And what if we wanted to self-fund? And what I will just say is this should be a part of it should be a discussion for your retirement plan. For a lot of people, they choose to self-fund, and there's some strategies that you can do to self-fund instead of buying one of these policies. Dave Ramsey is a financial expert. A lot of people know the name. He always recommends people start looking at long-term care insurance at about age 60. And it costs nothing to run a quote to see, so if you're working with a financial planner, say, hey, why don't you run a couple illustrations of what some long-term care insurance policies would cost us and the benefits and how they work, and get a understanding, at least start that conversation to say, hey, if we did decide to go with one of these policies, what would it cost us? How do they work? How do we get money out of these things? Understanding the elimination period, which we talked about. That's what you want to have a better idea and understanding of, so you actually know what you're getting. And then once you've gone through all the details, you can understand, hey, is this something that we want to pursue, or maybe just go the self-funding route, which is what a lot of people nowadays head towards. And one last thing with traditional long-term care insurance is it's more expensive to insure a female than it is a male. Same age, same health class. It's just that these insurance companies know the likelihood of a female utilizing one of the policies is a lot greater than her male counterpart. And again, these insurance companies, they just go off of statistics. They just look at the data, and that's how they price these different policies. And they know statistically that women are more inclined to actually use the policy than a male of the same age and same health class. And therefore, the male's premium is going to be lower, and quite a bit lower when you run comparisons. All right, question number 3. Somebody wanted to know what the Obamacare subsidy cliff is that returns in 2026. What do they mean by this? Okay, we will have a link in the show notes to this. There's a good article on healthinsurance.org that kind of explains this in more detail. But essentially, for those people that are on the healthcare exchange or Obamacare, whatever you want to call it, let's say you retire, you're not yet eligible for Medicare, which for most people, if you're not disabled, is age 65. Let's say you retire at 62 and you go on Obamacare, the healthcare exchange. The subsidy that you get towards your premium that you pay for your health insurance is income-based. Right? It's up to 400% of the federal poverty level. And essentially where you fall income-wise is going to dictate how much of a subsidy that you get towards your health insurance or that you don't get. Now, if you wanted a bigger subsidy, you might plan for a lower adjusted gross income for the years that maybe you're on Obamacare. And the bigger the subsidy that you get, the lower your premium that you actually pay out of pocket. Now, with the cliff, with that being reintroduced, essentially it is like if you imagine a cliff, once you go over and above that limit, if you happen to fall above that particular limit, then you got to pay back all the subsidy that you got, which, all it takes is $1 above that income limit to then throw you over the cliff, so to speak, and then you've got to pay all of it back. So you really, really want to be careful. This is something you want to plan as far as your taxable income in retirement. If you're on Obamacare and you're getting a subsidy, what your health insurance costs are going to be, this is something that you need to plan ahead, in my opinion, just so that you don't fall into one of these situations where, for example, we had somebody that contacted us a long, long time ago that they went over the cliff when they were on Obamacare, and I forget tens of thousands of dollars of subsidies that they had to pay back because their income was above a certain threshold. So you want to be careful and you want to map this out properly so that you're getting the right subsidy and paying the right premium based on the income that you expect to have while you're on Obamacare leading up to getting on Medicare at age 65. Now, it's important to note whenever if you were to sign up for Obamacare, what you're actually doing is you're telling them an estimate of where you expect your income to be that next year. And depending on what you report, that's going to determine how much of a subsidy that you actually receive, and therefore how much of a premium that you pay for your health insurance. So the better you can have your taxable income dialed in as accurately as possible, the better off you're going to be to avoid paying back some of that subsidy and running into that cliff that we just talked about. Question number 3, somebody wrote in and said, other than Social Security timing, like when you claim your Social Security benefit, what are the other most pivotal decisions that one makes in retirement planning? And boy, that's a good question. And it's going to be different depending on the person. For example, we had a client that worked for a Fortune 500 company, and they had a big decision to make as far as claiming the pension option, the monthly pension option. And there were a variety of different choices like single life, joint and survivor, 50%, 75%, 100%. There were even a couple choices, 5-year certain, 10-year certain option. And then there was also a lump sum option, which was almost a 7-digit number. It was a very, very big number. So when you're talking about choosing between a lump sum option of a $900,000 lump sum or a lifetime annuity option, and again, there's a variety of different choices, that's a big pivotal decision that one needs to make. Now, again, not everybody has a big pension choice like this, but certainly if you do have a pension, no matter what the size, that is going to be one of the crucial decisions you make that's going to impact you in your retirement for the rest of your life, because a pension is for the rest of your life and possibly your spouse's life if you're married. So what's the commonality of those first two? Social Security is lifetime income. Pension could be lifetime income if you don't take the lump sum option. And I've said it before, I'll say it again. Social Security does have a cost of living component to it, meaning if there's inflation, your Social Security check and income could go up over time. Your pension income, depending on if it's public or private, might have a cost of living component to it. And if I had a pension, I won't ever have a pension personally, but if I did, I would want to, number one, look at, okay, what is the history of cost of living adjustments for my pension? Those are published. You can see what those are. And if it's a fixed amount for life, meaning there's no cost of living adjustment, just realize that's less valuable than much less valuable than a pension that does have a cost of living component that will go up or has the potential to go up over time with inflation. Now, other pivotal decisions that one has to make, that we all have to make, is a withdrawal strategy. This is one of the most popular topics we've ever done on the podcast, is coming up with a withdrawal strategy that makes sense, that's tax efficient, it's well thought out, it's stress tested, and a withdrawal strategy that has the ability to be flexible as things change. What could change? Markets could change. Taxes could change. Social Security could change. And if you look at how underfunded Social Security is, there's going to need to be some changes to keep the Social Security system solvent. So again, your withdrawal strategy will have to be flexible as these different changes and curveballs come at you. A perfect example of this is with the One Big Beautiful Bill. When that was passed, boy, that changed things. Not as significantly as was proposed, the final version of it, but it certainly probably would change your withdrawal strategy. I know it did for most of our clients. Another pivotal decision to make that each one of us is going to have is whether Roth conversions make sense and when, where, and how much of a Roth conversion really makes sense in our particular situation. Because there's some people out there that it's just not advantageous to do Roth conversions. And there's other people where it's a terrific idea to incorporate a Roth conversions throughout their retirement, at least maybe until RMD age. Another pivotal decision that people have to make is what they invest their retirement savings accounts in. Now, we've run into people that put 90% of their money that they have saved for retirement into one insurance product, and then they live with regret most of their retirement. I won't go into that too far, but again, that's a huge pivotal decision to make, is how are we going to invest those dollars now that we're retired to either produce income, interest, dividends, get growth from it, hopefully growth, because that decision is totally yours. If you're working with a financial planner, maybe you've got someone in your corner to help make those decisions with you, not for you, with you. That's very, very important. And believe me, when I say the choice is yours, I have witnessed everything under the sun. I have witnessed people that have put all their money into one individual stock. That's not encouraged, but some people have decided to do that. I've seen other people that have a beautifully diversified portfolio with buckets and a plan to go along with it. I have seen other people that have all their money in gold or silver. So I guess it takes all kinds, as they say. But really, that choice is up to you and what you want to invest your money in to give you the highest probability of success and a lot of confidence, hopefully. And I think above all, The most pivotal choice that you're going to have in retirement, and believe me, I've thought about this question a lot, is the withdrawal strategy, but more so your spending in retirement. Because when every day is a Saturday, I have witnessed a lot of people get themselves into trouble because they spend. And if you're like me, I spend the most amount of money on the weekends. And then in retirement, some people that maybe don't live on a budget, and if they set up a retirement plan, they veer off or they stray from it and they don't follow the plan to a T, and they get themselves into trouble by overspending. And when you overspend, a lot of times what happens is the withdrawal strategy that you started with is now blown up, and now you're paying more taxes than you need to, and you have a higher chance of running out of money in retirement. And that is a terrible feeling. Imagine you're a number of years into retirement and you have been spending and spending and spending, and you're looking at what you have left of your retirement accounts, and you're trying to determine how long is this money going to last. I kind of went wild with my spending. It didn't stick to a plan or a budget. And whether you want to admit that or not, you've got an X amount of dollars left, and it's got to last as long as you do. And at some point, you might come to the reality of, gosh, how long is this money going to last? And what do I do when it runs out? And then I'm living purely on Social Security. That's a very, very frightening feeling. So this pivotal decision is how you spend and stick to a budget in retirement, because you will have finite resources. You just can't spend like you're in Congress. You've got to stick to the retirement income, the withdrawal strategy to keep you on track and make sure the money lasts. Because the worst feeling in the world in my eyes is, okay, my life savings is now spent through. I have a paycheck, I have Social Security and maybe a pension coming in. And how do I make it on that? All right, that's all I got today. If you've made it this far, thanks for listening to the Retirement Made Easy podcast. I'll see you next time. And remember, always dream big.
Content in this material is for general information only and not intended to provide specific advice or recommendations for any individual. The content in this material does not necessarily reflect the views of LPL Financial. This is a hypothetical example and is not representative of any specific situation. Your results will vary. The hypothetical rates of return used do not reflect the deduction of fees and charges inherent to investing. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments might be appropriate for you, please consult your attorney, tax advisor, or financial planner prior to investing. This is a hypothetical example and is not representative of any specific investment. Your results may vary. All performance referenced is historical and is no guarantee of future results. All indices mentioned are unmanaged and may not be invested into directly. There is no guarantee that a diversified portfolio will enhance your overall returns or outperform a non-diversified portfolio. Diversification does not protect completely against market risk. All investing involves risk, including loss of principal. No strategy assures success or protects against loss. Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution, RMD, in the year you convert, you must do so before converting to a Roth IRA. This information is not intended to be a substitute for specific individualized tax advice. We suggest that you discuss your specific tax issues with a qualified tax advisor. Fixed and variable annuities are suitable for long-term investing, such as retirement investing. Gains from tax-deferred investments are taxed as ordinary income upon withdrawal. Guarantees are based on the claims paying ability of the issuing company. Withdrawals made prior to age 59 and a half are subject to a 10% IRS penalty tax, and surrender charges may apply. Variable annuities are subject to market risk and may lose value. Riders are additional guarantee options that are available to an annuity or life insurance contract holder. While some riders are part of an existing contract, Many others may carry additional fees, charges, and restrictions, and the policyholder should review their contract before purchasing. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution, RMD, in the year you convert, you must do so before converting to a Roth IRA. This information is not intended to be a substitute for specific individualized tax advice. We suggest that you discuss your specific tax issues with a qualified tax advisor. Retire Strong Financial Advisors and LPL Financial are not endorsed by or affiliated with the United States Social Security Administration or any government agency. Retire Strong Financial Advisors and LPL Financial are not endorsed by or affiliated with the U.S. Centers for Medicare and Medicaid Services or any government agency.
Thank you for listening to the show today. Check us out at our website, retirementmadeeasypodcast.com. And if you want some help from Greg, submit your questions at the bottom of the page or sign up for a 30-minute retirement coaching session with Greg. We'll see you next week.